Here's something that might surprise you about retirement math. The safe withdrawal rate everybody talks about isn't actually one number. It never has been. It's designed to move. And once you understand why, you'll never look at retirement planning the same way again. Hi, I'm Mark Wisniewski, president of Southern Incomes. Today, I want to break down why the percentage you're told you can safely spend each year in retirement shifts depending on the market you're stepping into. If this is helpful, go ahead and like the video and subscribe. And if you'd like to talk through where you personally stand, there's a link below to book a time on my calendar. What drives the number? Valuations and yields. Every year, a major research firm publishes a report on retirement income, and their recommended starting withdrawal rate has ranged anywhere from 3.5% to 5%. Some years, it sits closer to 3.7 or 3.8%. Other years, it climbs towards 4.7%. That's not indecision. That's the number doing its job, adjusting to real conditions. A withdrawal rate is really just a calculation based on assumptions, expected market returns, inflation, volatility, the order returns arrive in, and how long retirement needs to last. Of those, expected future returns carries the most influence, and returns don't look the same way from one decade to the next. Two things mainly drive those expectations: how expensive stocks currently are and what bonds are currently yielding. There's a valuation tool that measures how pricey stocks are relative to the last 10 years. Historically, higher stock valuations have been associated with lower long-term returns over the following decade, while lower starting valuations have often been associated with stronger long-term returns. It's not a guarantee, but it's a relationship investors have observed for decades. What you pay for something is one of the strongest predictors of what you'll eventually earn from it. Bonds are simpler. If the 10-year Treasury yields around 5%, many investors would generally expect long-term bond returns to be in that neighborhood, although actual results can differ. Combine both and the picture is clear. Expensive stocks plus low bond yields means weaker expected returns and a lower sustainable withdrawal rate. Reasonably priced stocks plus solid bond yields means stronger expected returns and more room to spend. That's the whole mechanism behind why this number shifts year to year. Let's compare two retirees. Same portfolio size, same age, same withdrawal method. The only variable is the year they retired. Retiree A retires in 1982. Stocks are cheap. Bond yields sit above 10%. Inflation is finally easing. That's as favorable an entry point as retirement math gets. Retiree B retires in 2000, right at the dot-com peak. Stock valuations are near historic highs. Bond yields are decent but unremarkable. Same portfolio, same strategy, completely different roads ahead. The year 2000 retiree lived through a flat market and two crashes. The 1982 retiree rode into one of the strongest bull markets on record. So the real question isn't what's the safe withdrawal rate, it's starting when. Where does today's environment fit? And today's answer looks different again. By several commonly used valuation measures, U.S. stocks remain relatively expensive compared with long-term historical averages, which has historically been associated with more modest long-term return expectations. But bond yields are meaningfully better than they were a few years ago, and bonds often make up a meaningful portion of a retiree's portfolio. So today isn't as difficult as the ultra-low rate stretch of 2020 or 2021, but it's also not one of the more generous environments retirees have entered. This entire approach is built on decades of retirement research. Some of the earliest work laid the foundation for the original 4% rule. Later research showed a clear link between starting valuations and safe withdrawal rates. Other studies combined valuations and bond yields to examine how the starting environment shapes the entire retirement. The conclusion across all of it stays the same. The environment you retire into matters, and it matters a great deal. So, where does that leave the well-known 4% rule? The original research from 1994 examined U.S. market data all the way back to 1926 and asked what starting rate could have survived even the worst 30-year stretch in history, adjusted for inflation. The answer was roughly 4%. Strong research, still valuable, but backward looking and static. You pick a number on day one and rarely revisit it. The modern approach looks forward instead, weighing current valuations, yields, and probability, asking what starting rate gives someone a 90% chance of their money lasting 30 years. Because those inputs shift, the numbers shift too. 2022 is a clear example. Bond yields rose sharply, and the recommended withdrawal rate was adjusted upward, since a larger bond allocation could finally do more of the work. This also explains the range within a single report. A rigid, never adjust approach might only support a 3.7 to 3.9% in a tough market. A flexible approach that adjusts spending more modestly can often support a 4.5 to 5.5%. On a $1 million portfolio, that's a difference between roughly $37,000 of starting income and $50,000 plus at comparable risk. Why the gap? Because flexibility neutralizes the single biggest threat to any retirement plan: sequence of returns risk. During your working years, a bad year followed by a good year just washes out over time. Retirement whoosh, flips that. Now you're pulling money out, so the order returns arrive in matters enormously. A crash 25 years into retirement usually isn't a major setback. A crash in year 2 or 3 is a completely different story. You're forced to sell at the worst possible time, locking in losses. That's the common thread among the toughest retirement classes in U.S. history. 1966, 1968, 1973, and the year 2000. Each launched into a weak environment, then hit a stretch of poor early returns. That combination quietly derails otherwise solid plans. So, how should someone actually use the withdrawal rate? Think of it as an ongoing framework, not a one-time decision. Years 0 through 3, the discovery phase. High valuation and low yields might mean starting around 3.5 to 4%. Moderate conditions might land between 4 to 4.7%. Low valuations with high yields could support 4.5 or even 5.5%. Sequence risk runs highest here, so caution matters most. Years 1 through 10, the stress test phase. Picture someone starting with $1 million, withdrawing $40,000 a year, a 4% rate. If markets perform well and the portfolio climbs to $1.3 million while spending rises to $45,000, the effective rate actually drops to roughly 3.46%. The plan gets safer. Now, picture the tougher version. 3 years in, the portfolio falls to $750,000 during a rough inflationary stretch, while spending stays near $40,000. That's a 5.3% effective rate, edging into risky territory. This is where adjustments earn their keep, in order of how much they sting. First, pause the inflation increase for a year. Most people barely notice. Second, trim discretionary spending. Cut the draw by 5 to 10%. Third, look for income elsewhere. Delaying Social Security, refining your tax strategy, or eventually tapping home equity. This overall approach is often called a guardrails strategy. Spend a bit more when the portfolio performs well, and pull back when it dips below a threshold. Years 10 through 20 and beyond, the stabilization phase. A plan that survives the first decade often becomes safer from there. Fewer years left to fund. Compounding has done its work, and Social Security is typically active by now. Healthcare costs, especially Medicare-related expenses, remain a major line item here, which is why factoring healthcare into an income plan matters so much. Research also shows that inflation-adjusted spending naturally tapers by 1 to 2% per year during those middle years, often as travel and dining out starts to slow down. A plan that felt fragile in year 1 can become genuinely robust, even abundant, by year 15 or 20. Build a flexible income system. Withdrawal rates shift not because researchers keep changing their minds, but because the underlying math never stops moving. Stock valuations move. Bond yields move. Inflation moves. None of those numbers are inherently right or wrong. They're answers to the same question asked at different points in time. The old mindset was find the perfect number. The better mindset is build a flexible income system, a sensible starting rate, guardrails, cash reserves, an income floor, maybe delayed Social Security, a tax-aware withdrawal sequence, and the willingness to hold steady in rough years and enjoy a bit more in the good ones. Flexibility tends to matter more than the starting number ever will. So instead of searching for the one perfect percentage, the better question is, what does my entire income system actually look like? If you'd like help building a retirement income plan around your own numbers, book a call with me, Mark Wisniewski at Southern Incomes, using the link in the description. Thanks for watching, and I will see you in the next video.